Hi everyone, my name's Darryl Panes, CEO at As Good as Gold Australia, and today once again I'm joined by my brother Brian and partner at As Good as Gold, and today we interviewed John Adams, Chief Economist at As Good as Gold Australia. Good morning, John.
Good morning, sir. How you going?
Very well, John. It's been a long time between drinks.
Yes, we have had a lot of things go on in terms of As Good as Gold, but a few other sort of things with Christmas and a few things that have been happening. But it's good to be back.
Yes, I mean, as my father would say, there's a lot of water flown under the bridge since we spoke last, but lots to talk about. Lots been happening. It's been a couple of months, and what I thought would be a really good idea would be to sort of probably go back to towards the end of last year, towards the end of 2018, and now we're in the infancy of 2019. But let's just have a look closely. Tension between trade wars are escalating. United States, China. Stock market, of course, has experienced considerable volatility. And for Australians, real estate market has really started to deteriorate, and it continues to move down in a downward spiral. So I thought what we might do is concentrate a little bit on the housing market. You've been talking about that for some time, of course, John, preparing everybody for what you believe is economic Armageddon. So you've been preparing us all for this, and now all of the pieces of this jigsaw puzzle are starting to fall into place. So I thought we would start with that and just get your impressions of where you think the real estate market is headed now and through the rest of 2019.
Oh, sure. So what we saw, so obviously in the second half of 2018, we started to see house prices start to accelerate quite quickly, particularly in Sydney and Melbourne. And obviously Perth has been declining for a couple of years with the decline of the mining boom. And then obviously we've had a whole host of issues with the Royal Commission, a whole host of issues in terms of the banks and how they give out mortgages. So a number of factors sort of came together last year that sort of contributed to the decline in house prices. And we saw that house prices across the country in December. It was the biggest fall in monthly house prices since 1983. So December was a very bad month. And what we are seeing in January and in the start of February is that house prices across the country, but particularly in these key markets, those falls are starting to, they are continuing. We also saw this week that the ABS, the Australian Bureau of Statistics, released the mortgage lending data. They released data for corporate lending and for personal lending, and within that personal lending is data around mortgages. And we're seeing that with mortgages, but also with non-mortgages, the amount of new borrowing that's occurring in the economy is actually slowing. So we've been talking in a number of these videos about a debt bubble. So the debt bubble is still growing, but it is growing at a slower rate. And the data this week shows that the rate of growth continues to slow. And what does that mean for house prices? Well, generally, if you are seeing a slower rate of issuance of mortgages, that points to further declines in house prices going forward. So we're seeing that. We're seeing also China. The Chinese government this week put in new criminal penalties around people trying to take their money out of China. So Chinese investors, a lot of Chinese investors have tried to get their money out of China because of the risk that they see with their wealth vis-a-vis the Chinese government. And obviously one of their favorite places to invest has been Australian real estate. So I think with declining new lending or slowing new lending, plus some of these capital controls the Chinese government has been putting in place this week, we're going to see further declines in property prices, particularly in Sydney, Melbourne. And the other interesting thing we've been seeing is a lot of the mainstream banks and mainstream economists, their forecasts continue to change. First, they said it was going to be a decline of 5%, then 10%, then 15%. And now we're seeing that, for example, Shane Oliver at AMP is saying peak to trough could be 25%. And slowly but surely, the industry is catching up with some of those more dire forecasts.
Yes, well, it seems that they're starting to fall in line a little bit more with your predictions. That's really what it's looking like, isn't it, at the moment?
It definitely is important to point out that when I have talked about economic Armageddon in a whole host of articles I've been writing about, the Armageddon is not house prices falling. It is when the debt becomes unserviceable. And obviously we have a debt bubble in Australia. The debt bubble continues to grow. We have a global debt bubble, more than 250 trillion. And we're starting to see the beginning signs that in terms of the serviceability of the debt is starting to become an issue in a range of countries overseas.
John, when you've got 1 million households that are experiencing mortgage stress, what does it take? Does it take 2 million to experience mortgage stress? 3 million? I mean, when does it really break? Is there an equation that one can work with here or not? I mean, there is a limit, isn't there? And one would think 1 million is pretty much the limit.
So what we have found out is over the last couple of months is 1 million households are in mortgage stress. So the key data source is Martin North's Digital Finance Analytics. He has probably one of the best mortgage stress data sets in the country. So that it definitely is a whole host of people already struggling to pay their bills. A lot of people are trying to get things like using credit cards or payday loans to try to make ends meet. So some households are piling debt upon debt. What is going to take? I mean, obviously, historically, when interest rates go up, that is typically the catalyst for people to start to default. It's true to say that defaults in Australia are still very, very low. So even though people are struggling with these enormous sums of debt, it hasn't translated to people, walking away from their properties. Now, if interest rates were to go up, that easily could be the catalyst, or if we start to see things happen in the international financial system that starts to impact our banking system, those ramifications could impact people's ability. So, for example, if unemployment went up, or if the availability of credit was to dry up, or if the overseas interest rates went up and the banks had to pass those interest rates on, independent of the Reserve Bank, those could be some factors that could lead to these households that are in mortgage stress going to the next step of actually defaulting. But so far, the rates of default hasn't risen dramatically in Australia, but the same can't be said for countries overseas.
The Opal Tower development, the real estate developers over there, the dodgy real estate developers that have created some major problems there. It's not just Opal Tower, by the way. It appears as though that there could be thousands of developments like this under scrutiny at the moment that are all at risk. This, of course, puts a huge dampener, of course, on the real estate market over here in Australia as well, doesn't it?
Yes. So obviously, I mean, we've seen A Current Affair, we've seen 60 Minutes, we've seen a whole host of TV shows talk about Opal Tower. I mean, in terms of for the viewers, I mean, so the thing that happened just before Christmas was residents were in Opal Tower, and then a few days before Christmas, they heard a big crack all of a sudden at about 2 o'clock in the afternoon, and everyone didn't know what it was, and it was parts of part of a wall on a couple of floors had a big ruption. And that obviously led to a whole host of hysteria about the structural integrity of the building, the quality of the building, what did the developers do, the builders, etc. So a whole host of residents had to be evacuated. There's been enormous amount of remediation work in terms of that building. But the question is, will that be enough to reassure residents that everything is fine? I mean, there are people in the industry who basically said that the design of the building is so flawed that they really need to demolish the building and basically try to start again.
Wow.
So yeah, I mean, there are some very strong voices in the real estate industry who are saying that. But you are correct. I mean, Opal Tower is not an isolated incident. We're seeing a whole host of building issues right throughout the country. So Sydney, Melbourne, there's stories even I'm hearing in Canberra I'm not sure if you're hearing anything in terms of Adelaide, but yeah, I mean, look, we're starting to see a whole host of and a whole host of issues. And one of the important reasons to why are we seeing these issues, it is because of the debt bubble, because a lot of people are finding it hard to either to access credit or to pay these loans. Developers are trying to cut corners and to
correct
this so they can get their properties on the market and obviously offshore or try to offload the assets so they can walk away. They can sell them and then walk away with the money. So it is the bubble. It is things to do with the financial system and the ability of people to borrow and to pay these loans that's actually causing these developers to panic, to take shortcuts. And we're seeing a whole host of buildings and in a number of capital cities that have massive structural integrity issues.
Yeah, it's a massive issue. We've just had a Royal Commission and into the banking sector, and I know that the banking system at the moment, they've tightened up on their lending criteria. That's become very evident. However, it does seem that our government is very, very keen to keep this whole facade moving on so that money is still relatively easy to access. We've got interest rates at 1.5%, and there seems to be no thought in mind to increase interest rates in Australia, if anything, to lower interest rates. So it would seem as though it's a recipe to increase debt. I just see it that there's a lot of money available at cheap interest rates, more debt. You've already quoted that the Australian debt level is at all times high, highest ever in recorded history, and yet the policies in Australia at the moment are leading towards increasing that debt, unquestionably. A gentleman by the name of Vern Gowdy, and I have made reference to him before, but an economist here in Australia, wrote the book, I think it's The Death of Australia, but he said there is only one way to go broke, and that's to have too much debt. And that's where we're heading at the moment. There seems to be no suggestion that we're going to move away from that line of thought. So what are your thoughts there?
I mean, you've raised a couple of important questions. One is about the Royal Commission, but then the other one is in terms of the amount of debt that is in terms of the economy. So in terms of the Royal Commission, I mean, I've written a piece for As Good as Gold Australia, and I think we sent it out to clients this week. My view is that the Royal Commission, it was a bit of a whitewash. It had 76 recommendations, dealing with a very set of minor issues. But in terms of the role of the banks, building up, giving out a whole host of mortgages that people couldn't afford, in terms of the regulators being lax, in terms of people breaching the criminal code, particularly around responsible lending, I don't see any sort of strong recommendations that was going to address those fundamental issues. So I think So obviously mortgage brokers have been hit by some of the recommendations, but mortgage brokers are, at the end of the day, just a distribution channel for credit. And if you shut down that flow of credit, people can still get access credit by going into a bank branch rather than going to a mortgage broker. So, even though mortgage brokers across the country are very upset with some of these recommendations, in the overall macroeconomic scheme, the Royal Commission, I don't think, tried to do anything that would try to affect the debt bubble. Okay. And you are correct. So the Morrison government is saying we have a strong economy. Obviously we're heading into the 2019 federal election. The economy is going to be one of the big issues that people will make a judgment about as to which government they want to obviously govern us for the next 3 years. And basically, the government, but also people in the banking system, the RBA, APRA, etc., they're all trying to put out a positive facade that everything is great. We've got a couple of sort of minor issues here and there, but overall we're very strong. But really, what we have a massive debt bubble that is causing significant structural issues with the economy, and those issues will come to a head in terms of one form or another. So in terms of the growth of the debt bubble, I mean, when you have an economy that is based on a lot of debt, in order to keep GDP ticking at a healthy clip, you need to keep growing the debt bubble. So obviously this is one of the reasons why the Reserve Bank, but also I would suspect Treasury, and maybe they put some behind the scenes pressure on the commissioner. I mean, it was not to disrupt the flow of credit into the economy, because if you do that, you're going to see the economy go into a very quick tailspin, and then potentially go into some sort of recession. So obviously, they are very keen to keep the debt bubble intact, to obviously keep it growing, to keep GDP up, and to push the illusion that everything is fine.
Yeah, John, I agree with what you've just said. And obviously, in the last 2 to 3 months in Australia, the Hayne Royal Commission has been on the television, newspapers, all of those sorts of things. And I've actually got a couple of points that I'd probably recommend, and see what you think would be advisable and may not be. But let's have a look. I've got down, maybe we should have, when we go for a mortgage, we should have a larger proportion of a deposit, because that seems to me that you're not borrowing as much, you've got a good savings plan. And the other thing is too, if you've, these days when couples buy a house, and they include everything. That includes curtains, curtains, the furniture, entertainment centres, and everything like that. Maybe that's something that we should start looking at. Maybe we could buy a bit later, so to keep that mortgage down. What are your thoughts?
One of the things that most Australians don't realise is about 60 to 65% of the bank's loan book. All of it is to do with mortgages. So compared to overseas banks and the overseas banking systems, the level of concentration of borrowing into the housing sector and the property market, I mean, it is very, very high. So one of the signals that we have a structural problem is the amount of borrowing that's going into the property sector. But I mean, for example, I just had a phone call the other day from someone who's involved in small business, and he's basically saying that he and his other people in small business, who are looking for credit, basically, I mean, for whatever reason, the banks won't touch them, and they're struggling to get, a credit for legitimate ventures. So parts of the economy where we want credit to flow so that we can actually grow the economy and generate wealth. Some of them are struggling to get money, and then we've got this big mammoth property bubble that the banks keep on feeding credit into. So everything you suggest, all of it sounds very legitimate, very prudent sort of way to manage either in terms of the issuance of mortgages or how households should manage their household budget in terms of not trying to buy everything today. If you want some fancy furniture or lifestyle stuff or entertainment, buy it when you can save up for it. But yeah, the powers that be are trying to convince us we can have it all now. And for the last 5,000-6,000 years of recorded human history, we've all learned that you can't have everything today.
Yeah, that's some valid points, and I remember my father used to talk about when he my parents bought their first home. He made the bricks for the home, and people went without carpets. They did the outside walls, and then they put the furniture in, and then they built the bedroom if that was the case. But yes, it's a total different way of going about a mortgage these days. Also, with the Haynes Royal Commission report, we also heard a little bit about the new regularity oversight body. It seems to me that we've got a new set of rules coming up for regulation, and a new government body is running at a loss. Your thoughts?
So one of the clear things that came through the Royal Commission was that APRA and ASIC, the two regulators that were regulating the banks, they pretty much did a very poor job. obviously we saw in the Royal Commission that the banks weren't following the law. They weren't following the rules or community expectations. And the question is, well, why were the banks not following the rules? It's because the regulators were very light touch. Some would say, and I would say, that they were captured by in terms of the industry. A lot of the staff in these two regulators come from the industry. So basically, there are massive performance issues that we are seeing with the regulators. The Hayne report, it was disappointing that they didn't try to clean up the regulators through some strong recommendations. But what they did put forward was this recommendation to have a new government body, which would have, in effect, oversee ASIC and APRA in terms of so maybe doing like a review every few months to sort of see, well, how are they performing? Are they actually doing their job properly? Where are the gaps in their performance, and how can they improve? Now, my big contention on this point is who can really, so for example, ASIC looks at how the banks issue mortgages, and APRA looks at the macro-prudential management of the capital reserves of banks. Well, who can actually make a judgment as to if the regulators are actually doing a good job or not? It's someone with sufficient industry expertise. So it's very likely, in my view, that if they do set up a new regulatory oversight body, the people who are going to be in this body are going to be from the industry, because they're the ones who can actually make an informed judgment as to whether the regulators are doing a good job or not. But I don't think that's going to necessarily resolve the problem, because what did we see over the last 10 to 15 years is the regulators were captured by the industry. That's why the regulators didn't enforce the rules harshly to keep the banks in check. And if you have bank insiders on this new oversight body, guess what? Looks like this new oversight body is going to be captured as well. So I don't see, with the Hayne Royal Commission report, I mean, yes, there'll be some changes on the periphery, but for example, in 2008, or 2007, 2008, in the US, you had these collateralized debt obligations. That was these toxic assets that led to the GFC. Starting in 2015, the banks started to reissue what they call collateralized loan obligations, but it's exactly the same stuff. It's just a different name. So we're seeing in overseas banking systems that they do the bad thing, that they cause damage, they get wrapped over the knuckles, and then 7-8 years later, they come back and do exactly the same thing. Well, the Royal Commission report was so weak that there is a big risk that in the years to come, the banks could go back to some of the behavior that we have seen, that we've seen over the last 10, 15 years, particularly giving mortgages out to people who don't have the capacity to pay, because there isn't a strong ability to rein them in.
Yes, for what you're saying, I think the Royal Commission has opened up a can of worms. I don't think this is going to go away very, very shortly. And again, I go back to my parents and the banking industry back then, and we're talking in the 60s, maybe 70s. You saw the banks were used money for mortgages. But as I see it these days, the banks are in insurance, they're in derivatives, they're even in the stock market. So, do you think that maybe the banks should move away from some of these areas where their expertise shouldn't be there? It should be in just lending money. What's your thoughts?
Australia definitely has, particularly with the big four banks. We have too big to fail banks, and obviously you look at overseas. There's a whole range of banks that are too big to fail. So the Royal Commission did examine this question of structural separation. Should you break up the banks along product or advice lines? There was a whole host of stakeholders who suggested that they should. The Royal Commission, the Royal Commissioner, Commissioner Hayne, came to the conclusion that there wasn't sufficient evidence that it should go forward. A lot of people have been very upset by that recommendation, including former Prime Minister and Treasurer Paul Keating, who thinks that structural separation should be on the table. So obviously the Royal Commission basically said, don't look at it. Now, what importantly happened this week was Pauline Hanson in the Australian Senate introduced legislation to break up the banks. So she basically said, well, the Royal Commission didn't consider it, so I'm going to push ahead on this issue. So she introduced legislation this week and that legislation has been referred to a Senate Economics Committee investigation. So that investigation should kick off hopefully in the next 2 or 3 weeks. And there'll be a whole host of people around the country putting in submissions. There'll be probably some hearings. It's probably going to flow over until after the next federal election. After the next federal election. So structural separation, won't go away. But from a monetary perspective, but obviously, we're here in sort of the gold silver space. The reason why too big to fail is important in terms of the sort of business we're in is if a bank is too big to fail and it does fail, you have a depression. So now, if you have a range of smaller banks, some of those, maybe you can let some of those smaller banks go, and you can still keep the economy going, and you don't have to have a massive crash. But when you have massively giant banks, and they're about to tinker over, and you don't want a depression, you've got to save the banks so that you can keep the banking system intact. Now, how do you do that? You do it with all the monetary heroin and cocaine that we've seen over the last decade, of zero interest rates, negative interest rates, quantitative easing. Basically, you've got to bastardize your currency so that you can keep the banks alive. So from a monetary point of view, banks that are too big to fail causes massive future risks for currencies. And the fact that structural separation wasn't pursued by the Commissioner, that I think imposes significant future risk for the Australian dollar. One thing I'll add on that point is that because some people have said, if just say, for example, Westpac was to go, well, Westpac is so big that it could easily bring down NAB, ANZ, and in terms of the Commonwealth Bank. So some people have the view that if one goes, all goes. So just say Westpac gets in trouble and the government is concerned that all big four that could go. Well, how are they going to rescue the banks? They're going to just print out a whole bunch of money. And they're going to do it with zero interest rates. The Reserve Bank has already opened up the window for quantitative easing. We could see a fiscal stimulus package coming up Canberra. And what does it all mean for the value of the Australian dollar? It all means a very negative trend in terms of what the future purchasing power of that dollar is. So too big to fail banks really does have a massive implication as to the stability of the economy, the stability of the banking system, but also how it may force governments to ruin the currency if you don't want to see a depression by the banks failing.
You've been saying for some time now that we could be very severely impacted on with our economy here if, in fact, there was a global economic downturn. So to just take us just aside from Australia for the moment, so we had a major disruption somewhere else in the world.
Yeah.
US, Europe, China at the moment have ended their QE programs. They've increased subtly increased their interest rates. Typically the United States, 0.25%, which took increased interest rates by about 1% over a year over the last 12 months. That's impacted severely on their stock market, car sales, and so what it would appear to have done is really impacted on their economy. We're reaching a point now where they don't have a buffer. If we're heading into a serious downturn in the economy, the rule of thumb, I believe, is, and you can correct me here if I'm wrong, that you'd need about 3.54% buffer to make an adjustment to reduce interest rates to obviously kickstart a falling economy or a fading economy. Now at 2.5%, or in Australia 1.5%, you'd be going into negative territory. So we seem to be remarkably vulnerable at the moment. So we're on the edge of a precipice. If European countries or America really start to take a fall now, then we seemingly have nowhere to go. That appears to be the case at the moment. What are your thoughts?
So Darryl, you raise several good points there. So the first one is, and I find this remarkable, is that U.S. interest rates, the official interest rate is about 2.5%. So, in terms of the bubble is so big. So go back 10 years. Greenspan took interest rates down to about 1% in 2003, and then raised them to about 4.5%. And that 4.5% was sufficient to pop the debt bubble because the debt bubble was big then. Well, the debt bubble is it's $85 trillion more globally compared to 2007. And yet the Americans can only take interest rates to 2.5% before the stock market starts to have the wobbles. Yep. So look, it's kind of like with a balloon. The bigger the balloon, the smaller the pin that you need to prick it. So obviously, central banks around the world have little to no room to move. And obviously, if you look at Europe, the Italian economy is in recession. Germany just came in with 0% GDP growth in the last 12 hours. And to be honest, the ECB has ended QE, but the Europeans haven't even raised interest rates yet. So interest rates are still at zero across the Eurozone. And you already have a couple of the economies either in recession or on the brink of recession. So we do not have a buffer. And so the IMF has said that if you do have a global economic recession or financial crisis, historically you need about 3 to 5% in terms of interest rates to cut. So that you can try to stabilize the economy. So even the Americans, with all this raising of interest rates, they don't have a sufficient buffer to be able to stabilize the situation. So and we'll probably go into some further detail in a separate video. But the IMF last week did put out a blog post that talks about how can they make negative interest rates work. You've got a range of countries around the world that have tried to introduce negative interest rates, and the one that has the most extreme regime at the moment is Switzerland with a negative 0.75%.
Great for the saving community, isn't it, John?
Yes, but one of the things that the economies around the world have found is that with negative interest rates, you've got this problem of physical cash, because if you've got a $50 note and you've got it in your wallet, what's the interest rate you're paying on that? You're paying zero. So you're not getting any money for it and you're not losing any money for it. And so where negative interest rates have been introduced, you have seen people taking their money out of the bank, hoarding the cash at home so they don't have to pay a penalty by keeping the money in the bank. And that obviously causes issues. So this is why we're seeing across the world a war on cash. And the Australian government, the Australian government and the Reserve Bank are involved in trying to reduce the level of cash in the Australian economy. So we can go into further detail in terms of in a separate video. But yeah, thing is that but even separate to the war on cash, the IMF is coming up with a whole host of new mechanisms of how they can make negative interest rates work, because they said some economies may have to take negative interest rates to -3%, -4%, which has never been done before in the history of economics. And people really don't know how that's going to play out in terms of what distortions that's going to create with the banks, with the households, and with various countries. But yeah, we're at a situation where the policy tools have really run out. And obviously, if they're trying to stop a depression from happening, it's very likely that they will have to, do massive amounts of, in terms of quantitative easing, helicopter money, universal basic income. They have to really ramp up the printing presses, kind of like a Germany or a Zimbabwe, just to have a hope of trying to stabilize this debt bubble. And the question then becomes is, what does that mean for inflation? What does it mean for the value of currency? And to be honest, there are massive economic and social repercussions from doing all of these sort of things, but the elites don't really care. Their view is that they have to keep the debt bubble intact, because if the debt bubble pops, a lot of the banks will go bust. A lot of these elites will lose their jobs. You'll have massive economic and social upheaval right across the world, and they're trying to avoid that. And it looks like that they're trying to avoid it through some form of runaway inflation, and that will cause a whole host of other problems that a range of countries will see across the world.
It seems there's no escape, John. Between a rock and a hard place, it would appear to me. And you correct me if I'm wrong here too, but I believe that corporate defaults have increased dramatically, in particular in China over the last 12 months, 2018, up again 2019. I believe at about $119 billion in defaults. This once again is a really bad sign, isn't it, that we're on the brink?
You make a couple of good points, Darryl. So basically, we saw that in 2018, we had a record number of corporate defaults in China at 119 billion yuan. We have seen a couple of large corporates in China. They have missed a couple of bond repayments in the last few weeks. One of those corporates went through a bankruptcy process last year and basically said, okay, we're going to clean up some of this debt and we'll be able to repay some of our debt going forward in 2019. And that corporate hasn't still been able to pay. And then we've seen another corporate get into a lot of struggle as well. So we're starting to see a whole host of forecasts that corporate defaults are going to ramp up in 2019. And this has spooked the Chinese national government. And in the past few days, they've ordered a review of all corporate bond holdings just to see how bad is the debt position of some of these corporates. The Chinese position is perhaps the most concerning, both for Australia, but also in terms of the world. Australia has enormous reliance on China, whether it's around trade or investment or even investment in the property sector. So if China gets into some sort of economic upheaval, Australia will feel it big time. But then obviously China has massive implications for the world because China has the biggest debt bubble, bigger than the US or the Europeans. So obviously what happens in China will have massive repercussions right throughout the global economy. And obviously if you start to see some big corporates, some big Chinese banks basically saying that we're done, and again, what is the essence of this Armageddon thesis? It is when a big fish says they can't pay, and then when they can't pay, they default. That leads to other parties defaulting as well, because once you can't pay your debts, that's going to impact on another person, who's going to impact on another person. So that's spreading. That's what they call contagion. And when you look at China, there's a very big risk that you could start to see the beginnings of the debt bubble in China popping, and that has massive implications for the global economy.
John, another sign. We could go on forever, of course, but time wouldn't permit. But auto sales are another big market, aren't they? And a very strong indication as to the condition of the economy. You've got General Motors at the moment, who are about to lay off 14,000 people. I think they've just recently laid off 4,000. I know that there's something like 7 million Americans at the moment that are 90 days behind on their commitments. This is another really bad sign. So we've got, we talked about real estate before, we've talked briefly about the stock market, now car sales. Your impressions, your comments on that?
In terms of what is happening in America, so household debt in America is more than $13 trillion. It's higher now compared to where it was in 2007, 2008. Leading into the GFC, what were the US banks trying to flog? They were trying to flog subprime mortgages. So people who basically shouldn't receive a mortgage to buy a house, they were being issued mortgages. Well, after the GFC, the banks changed the asset class and basically said, these people who can't pay debt, the subprime category, we're going to give them we're not going to give them loans to buy a house. We're going to give them loans to buy a car. And basically 9% of all household debt in the United States are to do with auto loans. And we are seeing signs that came out this week that 7 million Americans are behind on their in terms of their car loan repayments. So the reason why a General Motors or a Ford would be laying off workers is because households are so in debt in America that they can't buy a whole bunch of new cars because they've been racking up these loans to buy all these new cars over the last decade. And they're basically tapped out in terms of how much additional debt that they can get. So obviously, you won't see a lot of a very big, large increase of forward orders for cars. But at the same time, those who do go out and get a car loan and bought a new car, 7 million of them are already behind on their repayments. And that number, when it came out this week, it surprised a number of mainstream economists. So, we're starting to see this behavior right across the world, that whether it's governments or corporates or individuals, people have borrowed way too much debt. People can't make these repayments. We saw Christine Lagarde earlier this week, the managing director of the IMF, basically warn of a global economic storm, basically all about debt. And she basically said it only takes one lightning bolt to start a storm. And that lightning bolt is when a big fish says they can't pay. And we started to see the beginnings of people struggling to pay. It's always easy to see this, to see the big fish in the rearview mirror in hindsight. But because people ask me all the time, particularly over the last sort of 4 or 5 months, is, well, when's Armageddon going to happen, and where will it begin? And it's like, well, no one really knows the true financial position of all these big corporates, and in terms of the big banks around the world. But we're going to wake up one morning, and you're going to see in the news one corporate says, well, we're bankrupt, and that'll be it. That'll be the big fish. But where is that corporate? When will that corporate declare bankruptcy? Very hard to be precise about that. But what we do know from the course of human history is, people cannot increase their level of debt, to infinity. And at some point, mathematics is going to catch up with them, and someone's going to say, we're done. And that's going to sort of start the meltdown in the financial market.
Well, that's right, John. I mean, look, you reach a point, don't you, where you could have interest rates at zero interest, but you can't even afford to pay off the principal. That's the problem. So, and I think that's where we are now. And of course, when people stop spending, the economy slows down dramatically until it stops entirely. That's really where we are at the moment.
Yeah, I was going to say, Darryl, what you just said there is a perfect description of what's happened with the Italians. So the Italians, the Europeans have zero interest rates. They've stopped quantitative easing. The quantitative easing was fundamental for the Italians to keep on racking up public sector debt. But obviously the Italians are in way too much debt. They've stopped spending. That's pushed the Italian economy into recession. And obviously the Italians are starting to unravel. And it'll be very interesting to see whether the Europeans will reverse their decision about quantitative easing to ensure that the Eurozone sort of stays afloat.
Well, John, to carry on this conversation, I've got a heading here that I'd just like to read out. The establishment won't let the bubble pop. Number one, I'd like you to explain, who do you think the establishment is? With reference to the stock market going up in the stock market going down in November, December. Obviously, there was a dramatic turnaround in interest rates. So, who is the establishment, right? And let's talk about that stock market crash.
So in terms of the establishment, the establishment would be, I think it largely is the financial establishment. So I would call the international economic institutions from the IMF, the Bank for International Settlements, the World Bank. Then that feeds down into the central banks, and then you've got the commercial banks. Then you have, obviously, in terms of governments as well, because obviously politicians have an interest to ensure that their economy that it doesn't go into a big recession or a depression. So there's a whole convolution of vested interests that want to keep the bubble going, because they don't want to see the ramifications of the bubble popping. Because if you have a massive recession or a depression, a lot of people will be upset. A lot of banks could go bust. That's what happened in the Great Depression, particularly in America. A lot of banks go bust. A lot of these executives, would lose their careers, would lose their sort of portfolios, etc. But obviously, you would see politicians who are already in power, they'd be kicked out of office. And so there's a whole group of vested interests, both in Australia and across the world, who are basically saying, well, we've got to keep this going because of what it means to us. Because obviously someone will have to be blamed. and those who have created the bubble are the ones going to be getting the blame. And obviously, they're the ones that have the power, the political, the economic power at the moment to keep it going. And there's all the motivation for them to keep it going. But the consequences of that is to continue to degrade the monetary system. And we're already starting to see a whole host of countries around the world try to mitigate some of those risks. I mean, in 2018, we saw reports from the World Gold Council that says that we saw the biggest amount of gold buying by governments and central banks since 1971. And so there's a lot of countries around the world, whether it is China or Russia or Eastern Europe or some other countries, who are awake to how fragile the global economic system is. And they're basically saying, well, we need a hedge. Gold is a hedge, and that's why you're seeing this dramatic buy up of gold right across the world.
Yeah, you're spot on there. Obviously, the United States were trying to get the interest rates higher, so they had some dry powder in there so they could reduce the interest rates if things went wrong. Obviously, things are going a little bit wrong because I remember going back in the world financial crisis around 2007, 2008, and in Australia we had interest rates around 6%. They've dropped it to 3%. Now they've settled at 1.5%. So I don't think we've got a lot of dry powder left. Where do we go from here? Do we go to negative interest rates in this country?
The RBA governor last week opened the door to rates going down. The deputy RBA governor in December opened the door to quantitative easing. Next week's a very important week. We're going to see the House Economics Committee interrogate the RBA governor on Friday next week. So it'll be interesting to see whether the governor will get any tough questions about this. But everything points to zero interest rates, quantitative easing, potentially negative interest rates in this country, and particularly because we have record net foreign debt. It's very easy for international lenders, but also investors, to lose confidence in our ability to pay our debts. And if that confidence goes, the currency on the foreign exchange markets could collapse very quickly. And we've seen this numerous times, whether it was Turkey last year falling 32% in 3 weeks, or in the Asian financial crisis where the South Korean currency fell 40% in 3 weeks. So we could see a dramatic move like that with the Australian dollar. And it would be because we have too much foreign debt, and people have lost in our ability to manage our own economic affairs, and people just don't want to hold our money.
With this spending just going on and on and on between Liberal and Labor, and we know that there's no difference, where does it head Australia? Where does Australia go from here with this spending?
So I don't think there is a lot of difference between between Labor and Liberal. Labor wants to tax more in a couple of different areas, and they want to increase spending in a couple of different areas. But I think those areas are very, very minor in terms of the grand scheme of things. And in terms of where do we go, I do think that we're just headed towards some sort of currency crisis ultimately. Because I think it's going to come down to a couple of factors. I think if overseas events take us, take over the Australian economy, we could potentially go into we could go into some sort of deflationary depression, if things unravel and the global central banks can't stabilize the situation. But in terms of the Australian context, I think we're just pushing the limits of how big this debt bubble can blow up, and obviously, how much can the currency take? So if you think about someone who's overweight, and they go to the doctor, and the doctor says, well, you're at risk of a heart attack. Why don't you go do some exercise? Some of these people, rather than actually listen to in terms of their doctor, they'll just keep on, eating fatty foods or smoking or doing a whole bunch of those high risk activities until the heart attack happens. Well, that's how I sort of see what's happening in terms of economic policy. We're eating all those bad things. We're doing all of those things that we know is going to be bad for the currency. And it looks like we're just going to continue to do these things until the currency has a heart attack. When will that heart attack happen? We don't know. But if you want to call me Dr. John, I'm trying to say that the patient is sick, and we need to change some of these habits. But the patient doesn't want to listen to the economic medicine, and they're basically going to continue to do all of these bad monetary policy techniques until the currency, basically crashes.
Yeah, John. On this topic, but the last question I have, with reference to, we know the United States have a massive debt problem. We hear about it all the time. I don't think in Australia we are far away. And one question I would like to ask is, where do you think, with all this going on, where do you think the relationship of the Australian dollar will be to the US dollar? At the moment it's 71 cents to the US dollar. If the American dollar drops, does the Australian drop further?
Well, yes. So there's a lot of people who do believe that the Australian dollar will go to about 60 cents by the end of 2019 compared to the American dollar. So, so it could well be that if the currency was to crash, we could see the dollar down to 60 or 50. If you think about at the end of the Asian financial crisis in 2001, the currency fell below 50 cents compared to the American. So it fell about, in terms of, it got down to about 48 cents. So could it go that low again? It could. If we continue to print just like, some of these reckless countries like Venezuela or Zimbabwe, could it go even lower than 48 cents? It potentially could. But yeah, the thing is that there is no, if they try to stabilize the currency versus the American exchange rate, at some point they'll have to raise interest rates, and if they do, with an enormous amount of debt that we have in this country, those people who have debt on variable terms won't be able to absorb those high interest rates, and you're going to start to see a lot of defaults, and that could push the economy into a massive depression.
At the moment, John, this seems to me to be like the perfect environment for precious metals. Certainly the Eastern Central Banks think so. I believe last year, and from my research, last year, the buying of gold by central banks, the Eastern Central Banks, rose dramatically. First quarter, this quarter of 2019 accelerated again. Reminds me of what Jim Sinclair used to talk about. And he'd say, if you want to generate serious wealth, if you want to become a wealthy individual, just do what the major central banks of the world do. Own gold. Makes perfect sense. And that's what they seem to be doing at the moment. JP Morgan they've put forward a forecast on gold at $1,500 US spot 2019. So the big central banks, the big bullion banks, are forecasting big numbers for gold this year. Where do you see gold heading this year? What are your thoughts?
So I won't talk a lot about price, and the only reason why I won't talk a lot about price is we know that the gold and silver markets are being manipulated.
Sure, yes.
We had a former trader from JP Morgan testify. Or not only testify, but actually confess to the Justice Department that the banks are actually involved in manipulating the price. But I think in terms of the actual raw demand for the physical metal, particularly because the risks are mounting up in the global financial system, and people don't want to hold all of this confetti, whether it's about fiat currencies or whether it's about these bonds which have a high degree of risk in terms of default. We are going to see more buying of gold. We're going to see more buying of silver. There's a lot of players out there who think that at some point, the value of the gold and silver will be revalued to a much higher level. That's what they call the reset. So people like Jim Rickards, Jim Sinclair, Bill Holter, a whole host of people out there, particularly over in the US, think that some sort of reevaluation of gold and silver will take place. And if that were to happen, you're going to see a massive transfer of wealth, in terms of those holding the confetti compared to those holding the actual gold and silver. It is obviously one of the reasons why I've been buying precious metals for the last 2 or 3 years myself. And obviously that was one of the reasons why last year I decided to reach out to both you and Brian and become as part of the team with it in terms of as good as Gold Australia. So I think we're going to see the demand to increase going throughout the year, and obviously those who own gold and silver that have low debt, that are prepared for bad economic times, I think they'll be able to come through the storm relatively harmoniously. Those who are unprepared, they will suffer significant economic and social consequences.
Yeah, look, I think it's going to be a big year for precious metals. I've noted that JP Morgan haven't sold any of their rather large stash off yet at 850 million ounces. They obviously feel pretty positive about precious metals. I'll never forget the quote by Peter Daniels when, this is a long time ago when I chatted with Peter. He's been my lifetime mentor. But Peter said, "I do not care what happens in the world tonight, because tomorrow I'll still be able to get up and party." What did he mean by that? He knew that he had reserves. So no matter what happened, whether that be in the stock market, whether it be in real estate, whether it be the bond market, he knew that he was holding onto something that had true value. So no matter if any of those markets crashed overnight, he'd be okay, to the extent that he would be able to party tomorrow. Nice position to be in. So Robert Kiyosaki, same thing. Robert Kiyosaki has made a lot of money, of course, out of the real estate market, but says now it's all about cycles, and silver is in the cycle. We note that the ratio, of course, silver's closed in a little bit. The gold-silver ratio was about 85, 86 to 1, closed into around 82 to 1. But as we see that close in, if it closes into somewhere around 74 to 1, then we know that we've got a bull market in the precious metals area, and we can see that ratio closing in now. So the signs are very, very positive, and we know the demand, Brian and myself, the demand on precious metals for us at the moment is just huge, isn't it?
It is unbelievable.
Yeah. So I can only suggest to people that now is the time. They've really got to start looking at protecting their wealth. And as Jim Rickards has quoted consistently, 10%, because that 10% that you might hold in precious metals will more than accommodate for the downturn that the other 90% of your portfolio might experience. Brian, have you got any comments to make there?
Look, yeah, I just reiterate the demand for silver and gold has been horrific in actual fact, and we've had a massive demand on 1 kilo silver and 10 ounce silver cast blocks, and we certainly can't keep up with it at the moment. We're getting ahead of ourselves, but the bottom line is that there's this massive demand. And as I see it, and from history, we have in this country 7 billion people in the world. There's less than 1 ounce of gold for those 7 billion. And soon as that gold is taken up by the central banks around the world, the silver demand will be, we haven't seen anything yet. So I would reiterate with that, Darryl, that there's a lot of things happening in silver over the next couple of years.
I know, just sometimes you just don't recognise it, but a kilo of silver at the moment, we're paying somewhere around $100 more for a kilo of silver now than we were 3 months ago. In another 3 months, we may be paying another $100 a kilo for silver. So it's snuck up on us to some degree, but that's, I believe, where we're heading now. John, do you have any closing comments, mate?
Closing comment I have is things are getting worse. We're starting to see the first signs that Armageddon is coming because the debt is becoming unsustainable, unserviceable. So everything's pointing to that we're going to start to see some more bad economic news, more headwinds in 2019, but also going to 2020. So there is still time to prepare, but to be honest, for those that have, there is about it could be 15-16% of the country that is in that have negative equity, that if they sold their property today, that they still would owe money to the banks. So there's a lot of people who are already too late to prepare. But for those that are in reasonable financial shape, there is still a window. and all the signs is that things are going to get worse. And for those that have the ability to make some preparations, I would urge them to do as much as they can before the real party starts.
And maybe, John, that to finish off, or another good point to, and this might be a story for the next one, is that you raised the point a few months back of where is Australia's gold. We might have 80 tonnes, which is actually a pitiful amount, but it's not even here in Australia. So I think a good point would be bring back the 80 tonnes and to start buying up ourselves as a country, because no country has ever survived in the history of the world without some collateral, and that is gold and silver, or mainly the gold is collateral for the Australian country.
Yeah, all fiat currencies have failed, haven't they, Brian?
All fiat currencies have failed.
3,800 of them, over 5,000 years, not one survived. Okay, look, John, once again, we come to a point where we'd just like to thank you once again for your contribution. It is always fantastic. You're a very knowledgeable economist. You put forward some powerful views. We really appreciate your support. And we've got a bit coming up, haven't we, John? We've got another 2 or 3 interviews coming up because there's a lot happening on a lot of different subjects. So we've got another interview with you next week. And the week after, and the week after. So we've just got lots to talk about. So thanks again, John. Very much appreciated. Just a reminder to our viewers that we do have a GFC 2.0 conference coming up, and we have shifted the date in Melbourne to Saturday 27th of April, and in Sydney Saturday the 4th of May. Details are listed on the link below. So finally, most importantly, thank you to our viewers and our subscribers for your valued support. Until next time, stay well, stay focused. Catch up soon. Bye for now.
Bye for now.